Hey guys, hope you're well. It's Alessio. In this video, I want to talk to you about how we can identify a bear market in any market, actually, in Bitcoin. That also could be in other cryptos and also stock markets as well. So in this video, I'm going to show you how we can identify on the charts when a bear market or downtrend could potentially start. So join me. Alright guys, so as you can see here, by the way, let me just tell you where I am. I'm in the middle of what's called a Sisangan forest. As you can see here, this is quite a large foresty woods area in northern Iran. By the way, this place is much better than Tehran. I was absolutely boiling in Tehran, the capital of Iran. It was 31 degrees over there about a few days ago. Today is 22 degrees. Absolutely cool and great weather here. Great place to do a short video for you guys. All right guys, so in this video I want to show you a pattern that often repeats itself, usually on Bitcoin and cryptos, but you can also see this on the stock markets as well. So the pattern is how we can identify a downtrend, a reversal into a potential bear market. Now, let me make this very clear. I'm not expecting a bear market this year, okay? So in case you're thinking that I'm making this video because I'm telling you that a bear market could start this year, I think it's unlikely. It's not impossible, but I think it's less likely. Maybe a correction in the price is much more likely, but a bear market or downtrend, I think that's less likely. But in any case, it doesn't matter, because as I'm going to show you in this video, if a bear market starts, if a downtrend starts in Bitcoin, I'm going to show you how we can identify this on the chart before things get a lot worse. So, in other words, if the worst case scenario occurs, and Bitcoin does go into a bear market, then we'll be prepared for this, okay? So, by the way, look at this, guys. It's absolutely beautiful. Check it out. This is, let's go over here, guys. What do you think? Let's walk over here. It looks much more nice. All right, guys, let's continue. So, what I was going to talk to you about was this pattern. Take a look at this chart. Now, here we have an uptrend in the price of Bitcoin. I'm going to show you an example of this in the year 2018. So we had a major peak in the price of Bitcoin, as you probably remember, near $19,000 on Bitcoin in December of 2017. And what happened afterwards is, as you can see here, Bitcoin made a pullback to the 21 and the 34 weekly averages. Now, I know what you're probably thinking, oh my God, Alessio, not another video about the 21 average and the 34 moving average, because I have mentioned this quite a few times in previous videos, and I'm sure you're probably sick of it by now. But guys, listen, this is absolutely important, because this pattern is absolutely crucial to identifying a bear market. So yes, it is true, in previous videos I've talked about the importance of the moving averages, the 21 EMA on the weekly, and the 34 EMA on the weekly as well. But here's why it's even more important when it comes to identifying bear markets. You see, guys, in a trending market, in an uptrend, you do see several pullbacks to the 21 and 34 EMA. In the previous videos I mentioned, usually price bounces from these key levels. Usually when there's a pullback in a trend, in an uptrend, usually we see pullbacks down to the 21 and the 34 EMAs on the weekly. And once we get a pullback, usually price bounces. As you'll see here, there have been several bounces from the 21 averages and sometimes the 34 EMA as well on the weekly. But here's the thing. Suppose we get a pullback to the 21 or the 34 EMA on the weekly, and then we see a bounce. Okay, that's the thing. In the pattern I'm describing, we have to wait for a bounce, a strong bounce from these moving averages, from either one. It doesn't have to be both. It could be just one of them, the 21 EMA or the 34 EMA. Let's imagine we see a strong bounce from these levels, a strong rally after a pullback to these levels, and price rallies up higher, bounces higher again, okay? Now, what if the price then reverses and goes back below the low that was made prior to the bounce? So let me just make this very clear. Suppose price pulls back to the 21 or the 34 moving average in the weekly, see a strong bounce from these levels, and then price suddenly reverses. As you can see, this happened in 2018. Price reversed and went back below the low that was made prior to that bounce. In fact, we can draw a line on that level, the line that shows support. That line shows support where price bounced after a pullback to those averages. I think in 2017, 2018, I think it was, price did pull back to both levels, 21 and 34. It actually held above the 34, bounced off, and then look what happened here. Eventually price turned around and took out that support, took out that low that was made prior to that bounce. That is a dangerous signal, because when price rallies off these averages, so when price pulls back and then bounces off, rallies off these averages, and then fails to stay above that support, those moving averages again, and drops back below that support, below the low, that's it. Pretty much the probability of an uptrend gets lowered significantly. In other words, the probability of an uptrend continuing in Bitcoin or any market actually is significantly reduced. I'll show you another example. Same thing happened in the previous uptrend on Bitcoin back in the year 2014. I think it was 2014 when we saw a similar pattern. The pattern is, again, a pullback to the averages, pullback to the 21 and the 34 potentially, these moving averages. And then what happens is you see a strong bounce off these levels. And then what happens? The price fails to stay above these averages. In fact, it falls back below the support that was made. So price falls back below the low that was made prior to that bounce from those key averages, okay? So support gets broken. That essentially is a devastating signal because it's telling us something is not right. Price is failing to stay above support. Price is failing to stay above these key averages. And that's important because, as you know, in an uptrend, in a trending market, usually price holds these levels. In fact, even in the previous uptrend from, I think it was 2012 all the way up to 2014, we had pullbacks to the 21 average, to the 34 moving average, for example, and we held these levels and we bounced off. As we did in the uptrend from 2015 to 2017, we see these pullbacks and then we see market bouncing off. That's what you see in a trending market. But when things change, when price pulls back to the averages, bounces off and then fails and drops back down again below the support, below the low that was made prior to the bounce, yeah, that's not a good sign, guys. It's a devastating signal. It's a sign that the probability of the trend continuing is becoming significantly reduced. In other words, the odds are increasing for a reversal and a potential downtrend. Now, I know what you might be thinking. Well, hang on a second, Alessio. What happens if the price, let's say, bounces from the moving averages, the weekly averages, does drop again below the low that was made, prior to the bounce, and then forms an ABC type correction, ABC, and then moves up again? Yeah, that's true. That's absolutely correct. You might have a scenario where the price makes that kind of pattern, like an ABC pattern, and then goes up again, continues the uptrend. That is possible, absolutely. All I'm saying is, look, we're dealing with probabilities. When we look at the charts, when we're analyzing the market, when we're analyzing the price, we have to look at probabilities. And the fact is, guys, when price fails to hold these averages and drops below support, below the low that was made prior to the bounce, all I'm saying is the probability of a trend continuation becomes significantly reduced. That's all I'm saying. Oh, one more thing. There is actually another pattern you want to watch out for, which is, let's imagine the price does fall below the 21 and the 34 moving averages, and then rallies, bounces back to the 21, and then fails and drops back down again. What I'm saying is, guys, there's another pattern which shows that a bear market could be starting. And that pattern is, in a bear market, in a downtrend, rallies get sold. Rallies get rejected and they fail. For example, in a bear market, what you see is any rallies back up to the 21 or near the 21 average on the weekly, they get rejected and price drops back down again. We saw this in 2018, for example, and also in previous years as well. When price in a bear market, what price does is goes back to resistance, price bounces back to resistance, like a moving average, like the 21 average, and then fails to stay above that key level, the 21 average, and then drops back down again. So failure. Hi guys, how you doing? Got some people here who are having a good time. Okay. So failure of price to hold above the resistance levels, like a 21 average, is a devastating signal, especially for Bitcoin. And that could mean we could see a bear market starting, and that is why we want to be prepared for that if it happens. All right, guys, so the next thing I want to tell you is this. The next thing is that, look, I'm not expecting a bear market this year, okay? I want to make this very clear in case you think that I'm being very bearish, I'm expecting a bear market downtrend this year. No, look, I don't know. I mean, it might happen, it's possible, but I think it's less likely. All I'm saying is that on the balance of probabilities, when this pattern occurs, and it will at some point occur, I think this pattern very likely could happen once we see the beginning of a bear market. I don't think it's going to happen this year, maybe in the next few years, potentially on Bitcoin. But the bottom line is, the main takeaway is that if you see one of these two patterns, either a bounce off the 21 average after a pullback and then going back below it again, or rejection of price from resistance, so price rallying back to resistance like a moving average and getting rejected from that level and falling back down again, rallies getting sold, that's another sign of a bear market. Another sign of a bear market is usually that when sentiment gets crushed, when people become very bearish and pessimistic, it doesn't usually result in rallies. So in a bear market, despite pessimistic, oversold, over-bearish sentiment, you don't see price forming a bottom and rallying higher again. In fact, quite the opposite. In bear markets, negative or pessimistic sentiment does not result in a market bottom. So that's another thing you want to watch out for. Guys, I got to tell you, this place is really relaxing. I would highly recommend, if you come to Iran, even just visiting, come to this place in the north of Iran. It's called Sisangan Jungle, or Sisangan Forest. Over here in Persia, in Iran, they call forests jungle. But anyway, whatever it is, come and visit this place. It's really nice. All right, guys, I hope this video has helped. And if it has, please give it a thumbs up. And I look forward to seeing you in the next video update. Cheers, guys. Hey, guys. We just stopped again on the road. And Human's going to get us some bread, it looks like. Okay. We're gonna get some bread. This is Persian bread, just so you know. Okay. Looks pretty good. I can't wait to take a bite.